and then I'll start working through the paper itself. A couple things I want to say with respect to this, and Bob raises an interesting point, is I've really written this and I focus this largely from a firm strategy point of view, but I think there are a lot of policy implications. In fact, yesterday when I ran into you in the meeting room downstairs, I was meeting with somebody who works for the Japanese Ministry of Economics. We wanted to talk about this work and the work that they're doing related to this. So I think there's certainly policy implications. We can talk about them as we go through this. Interrupt me, I'd love to. I'll tell you where I think they're important. But let me give you a little bit of background about my approach to this topic. And so again, I largely approach this from a perspective I care about firms and their management, the strategic management of companies. And when we look at, and a lot of my work, as Bob mentioned, deals with the international activities of firms. When do they go abroad? When does it work? Is this a good thing? Is it not a good thing? Those types of things. And a lot of my work has generally dealt with direct investment. But I had a line of inquiry that I started a little while ago that focuses on exporting. And here I want to say this, that exporting is the predominant form of international participation. However, quite frankly, from a firm perspective, it's the one we know the least about. We know lots, there's huge international trade literatures, but a lot of that is often focusing on industries or trade flows between countries, and actually from the firm level, we don't know as much. And I'll allude to what we know and those types of things. And I think that's important, especially coming from my perspective, because nations don't trade. It's generally firms that do. And this is often a choice that they make and decisions that they make with respect to that. So if we want to understand exporting, we often have to understand it from the decisions or how this influences firms. So that's this line of inquiry.
Myles, what proportion of exporting is intra-company? And is that going to be a focus?
It will not be a focus at all with respect to this. What proportion?
It's about, it's a figure used for the United States is frequently about 50%.
Yeah.
Of total exports take place within multinational.
Yeah. And so I'm not going to talk about trade flow. These are going to be trade flows that are arm's length. I'm going to talk nothing about trade flows within companies during this presentation. Just to tell you where I'm going, and this is so if you want to pick up and leave at some point when it gets boring. The question that I'm focusing on is, does exporting, and here I want to focus on what I consider exporting as important here. It's geographic sales diversification. What is exporting? The definition is we produce at home and we sell overseas. And so really what the firm is doing is it's keeping production, because it generally starts as a domestic firm where it's domiciled. And the main difference of exporting is now we sell in markets that are in different geographies. And what I want to know, does that aid firms' ability to make capital investments? And I'm going to convince you that the answer is yes. Well, I'm going to try to convince you. How about that one? And let me just sort of summarize the story very quickly, and I'll go a little bit more in depth. If exporting is geographic sales diversification, if I sell in countries where the business cycles aren't perfectly correlated, I actually get a diversification effect. And this should help smooth my sales. And if I have a smoothing of, and another thing we know is that if we don't have perfect capital markets, capital investments are often constrained by firms' cash flows. They can't just go out and borrow money or get equity whenever they want. They often have to finance it internally. So the two things I'm going to look at is if we have smoother sales, we should be able to have smoother capital investments. But for me, the really interesting thing is I'm going to argue why I think that if we're going to have smoother sales in the future, why this requirement that we rely on internal cash flows might be relaxed. And so these liquidity constraints to investment might be relaxed. And that would be really strategically interesting and also important from a policy perspective.
Just a clarification question. So if your firms do not have access to the capital market in the countries they are exporting to, or international financial institutions?
They have access to capital markets. And I'll go into this, let me go into this a little bit more
Yeah, go
in
ahead.
detail, but if you
Yeah, that's
just...
fine, that's okay. I'll wait.
Okay. So before I dive into what I want to talk about, again, let me focus again on what we know on exporting. And again, largely arm's length exporting, not intra-firm trade, from the firm level perspective. So a couple things that I want to say here. First, not surprisingly, exchange rates are important, right? We know that they're important in predicting overall trade flows. Certainly they matter for firms also. There's one interesting thing, though, that we find at the firm level, and that is the notion of a sunk cost hysteresis. Here's what I mean by that. The argument is that there is a fixed, unrecoverable cost to commence exporting. We have to potentially find a broker, we might have to adapt our products to the foreign market, we might have to deal with logistics, and once we figure those out, we don't have to pay them again. But it's sunk in the fact that if we actually leave that market and would re-enter, we probably have to pay them again. So as a result, we have a hysteresis, which means is that if exchange rates are going on and I have to pay this sunk cost of entry that I'm never going to get back, I have to wait for exchange rates actually to take a big bump before I would enter. And I wouldn't enter, and I would enter much sooner if there wasn't that. And then when it comes to exiting, if exchange rates go to the point where it's unprofitable, well, I don't want to just exit right away, because if I exit and exchange rates become favorable overnight, I got to pay those costs again. So we have this hysteresis band, and it's indicative, the argument is, that we have this fixed, unrecoverable cost when we would commence exporting. So that's one of the things that we know when we move to the firm level. The other thing that we know when we move to the firm level is a lot of research, what it's tried to do is associate, and I'd say correlate, firm characteristics with what exporters are. So there's a lot of things we know about exporters. Exporters tend to be bigger than non-exporters. Exporters tend to be more productive than non-exporters. So we look at labor productivity, total factor productivity, that's the case. We know that exporters have more internationally oriented managers than non-exporters. Okay, you can see where this is going is it's nice to make these relationships, but they don't sort of tell what's cause and effect. Now, the reason we might have more internationally oriented managers, of course, is, oh, we're exporting right now, we better hire somebody who can actually do this, rather than we have people who have international orientations and decide, oh, we're taking the business overseas. So there was a lot of work to try and correlate firm characteristics with exporting. There's one in particular that I want to highlight there, and I'll come to this point in a second. It's that productivity one. And quite frankly, this is one of the most robust results I've seen in sort of years of doing research, especially across countries. No matter, across at least a dozen countries with these micro-level data, it is this productivity exporting relationship. Exporters are better firms. They are more productive. And you see that in the United States, you see that in Spain, you see that in Mexico, you see that in Morocco, you see that in Korea, you see that in Taiwan. Every study I know of that's looked at this finds that, which is fascinating. What's even more fascinating is they always, going back to this question of what's cause and effect, in this attempt to find out cause and effect, they all show the same thing too. Exporting is an outcome. Productive firms become exporters. It's not that there's this boost in productivity once you export. So it's all going one way. Productive firms are exporters, and again, the intuition there makes sense. If I have to pay for transportation costs, if I potentially have to adopt my product, I need some sort of competitive advantage if I'm going to actually sell something overseas. And so again, the evidence largely is that exporting is an outcome. So it's that more productive firms become exporters. And again, that's over at least those dozen or 14 nations by now that we've seen that. It's really only recently that we're beginning to see some evidence that, well, maybe there is some benefit to exporting, that these relationships between the exporters being better firms, and that there might be some reciprocal relationship. And here's both some work that I've done and one of my students also, Rob Solomon. If we move away from looking at productivity and we focus on innovation, so we look at your ability to launch new products, your ability to start patenting that affects your worldwide operations, we find that these things actually increase once firms commence exporting. So if we move away from just looking at productivity and begin to look at innovation, yeah, we're finding that exporting is more than an outcome. It could actually be beneficial, it could make these firms better. And that's really how I like to view this paper, or what I'm up to here is, I want to look at, again, exporting being more than an outcome. Does the fact that I export allow firms to do something that they couldn't do before? And I'm going to argue it allows them greater ability to make capital investments. So, why would that be? As I mentioned, it's really a diversification story. So we know that as long as business cycles aren't perfectly correlated across countries, we're going to get a diversification effect from exporting. And it's been long talked about, almost 40 years, that exporters have more stable sales than non-exporters. So their cash flows are going to be less dependent on the domestic business cycle. And Mahmoud, this is going to come back to the point that you raised. Okay, so you have stable sales, you have cyclical sales. Who cares, right? If you have efficient capital markets and I have a good idea, I should be able to get capital for that. Well, the cyclical sales, stable sales actually makes a difference if we don't have perfectly efficient capital markets and we have to rely sometimes on internal funds. So we aren't able to go and raise capital every time we think we have a good idea or we could demonstrate it has a good idea. So if that's the case, what it means that the stability in cash flows could actually be beneficial. So instead of when I have this trough in sales in a recession, I would generally be restricted from making capital investments. If I have more stable sales, if I'm an exporter, I probably don't have as deep a trough, and I can actually be relatively aggressive in downturns in the domestic business cycle. So one of the things I'm going to be looking for is, can I see this cash flow stability, and does this cash flow stability match up with stability in capital investments? That's one of the things I'm going to look for in these data, and I'm going to tell you about the data in that in a little bit. As I mentioned, for me, the really interesting thing is I think that exporting can actually mitigate these liquidity constraints. We might not be restricted on internal cash flows anymore. And there's two reasons why this would happen. One is, if I'm an exporter and I'm going to have more stable cash flows in the future because I'm not dependent on any one business cycle, I'm going to give the expectation to creditors or providers of capital that you're going to have stable sales going forward. You're not going to be susceptible to big troughs in any one country, and as a result, I'm more likely to lend you money because I don't think that you're going to be that dependent on any one market at any point in time. And so it actually could send a signal that there's an expectation of less volatile cash flows, and I would actually lend you money or I would provide equity when I wouldn't before if I thought you had more cyclical sales. Well, let me talk about this. Well, that really begs the question in my mind that, okay, well, let's say that, why don't I just wait until the domestic market goes into a recession and then I start exporting? Because that could give me the stability I need at that time. This comes back to that hysteresis effect. If there really is this fixed and sunk cost to commence exporting, if I wait until my domestic market dries up and I have limited cash flows and I have to pay this fixed sunk cost of entry, that's exactly the time I can't do it. I already have to have access for this to be beneficial. Otherwise, it would preclude me from doing that. The other argument, and this I can't, and these two, I'll spend a second afterwards about trying to empirically differentiate these and how I can't do it, at least I haven't figured out a way, is it's a signal of firm type. And here's what I mean by that. Remember I said that there's that unequivocal finding across at least a dozen or 14 nations is productive firms become exporters. Well, if I start exporting, and again, if we know this relationship and I have to compete in foreign markets, I'm signaling I'm a good firm. I'm a productive firm. And again, the signal's potentially credible because we have a fixed and sunk cost. If I just want to signal it, it's actually somewhat costly for me to do this. I can't signal it without cost. And so if I'm a provider of capital to you and I say, you're telling me that you're a strong firm, well, I'm actually going to lend you money now where I wouldn't before. Now, I want to, like I say, both of these are really information stories that we're revealing information when we commence exporting that could be valuable to providers of capital, and that revelation of information is actually what's going to mitigate our reliance on internal funds. We should be able to borrow or issue equity much easier.
So Myles, is it the contrary story then, if you see a company pull out, become less diversified, then that it's a negative signal, I'm a more risky firm therefore?
And I'm going to, yep, and which is going to be, for me too, if I can show that in the data, that would help tell me that there's something in being an exporter or not being an exporter. Yeah, so the counter story should absolutely hold also.
At the aggregate or macro level, we know that trade expands faster than domestic economies.
Yep.
And contracts faster than domestic economies. So is there something in what you're assuming about this firm that is insulating it from that macro experience? I mean,
And
exporters from Japan and Germany right now, don't feel particularly stable.
no, and I think that is a good point. What is going, there's going to be there's two things that I'd raise with respect to that. And one I can certainly show in the data when I move to it, is one of the arguments is the stability, or what might help the stability is, can I actually switch some of these sales? So if I'm losing sales domestically, can I actually push them through channels into foreign markets? And depending on what I'm selling, that might not be possible, and so this would be less of an issue. But that I would say. The other point I would be is, somewhat what is the counterfactual that we would want to consider in this case? And what I mean by that is, it's true, worldwide the major markets are all in recession right now. German and Japanese firms are really hurting. And so in my mind the question becomes, would they be hurting even more if they were solely Japanese firms? Or do they get some benefit from being there? And that one I can't answer. But I think you raise an important point that, yeah, there's the assumption that either these things are potentially negatively correlated, so one's booming, one's bust, that isn't going to be the case with major economies. They're going to be correlated positively still. If they're correlated positively, I'm assuming that there is some ability for the firm to make this movement to focus more on domestic sales, or to get some of that transition, to get the stability. And if that transition isn't possible, these arguments shouldn't hold. At least this one shouldn't. This one might still. Which actually, that might be one of the ways to try and identify these two. And let me tell you why I think it's important to identify these. From a firm's perspective, either of these are benefits to me. From a policy perspective, these have very, very different implications, right? So this one, from a policy perspective, if we say this, there could be an argument that we would want to encourage exporting by our firms because they haven't been making this, and now we've diversified. If we help them export, they have the stability, and that's potentially valued in capital investments. If the state or policymaker subsidizes exporting here, it could actually destroy the signal. It's no longer firms making the choice. In fact, we've made the signal useless. And that would actually have the wrong effect of what we wanted. And so teasing out what those are, I think, is really important from a policy perspective. From a firm's perspective, not so much. It would be nice to know. So I'll leave you with that thought as we move forward. And I do want to come back to this point about, what are the assumptions I'm making about what's allowing me to stabilize things. And I'll show you some of that in the data too.
Myles, it's also true, isn't it, that even if business cycles are highly correlated, if they're not perfectly correlated, you still get a little bit.
You still get some effect if they're not perfectly correlated. Absolutely. So that's really the key thing. So this is what I'm going to tell you what the data are in just a second. This is what I want to look at in the data. I'm looking at two predictions. Can I show that exporters actually have these more stable sales? So part of it's an empirical question. And if they have more stable sales, does that map to more stable capital investments? And the thing, like I say, for me is most interesting, does exporting allow the firm to do something it couldn't do before? Does it relax that investment liquidity constraint? So does it no longer have to be so dependent on internal cash flows to make investments? So where am I going to look for this? I'm going to look for it in Spain. And so these are data that I have access to from one of my former colleagues at NYU. So these are data collected by, and all apologies to any Spanish speakers in the room, the Fundación Empresa Pública, with support of the Spanish Ministry of Industry. I'm going to be looking at a 9-year panel from 1990 to 1998. Ian and Mahmoud, this is going to get to your point. So there's just over 3,000 firms in this sample and 2,200 from 1990. If one wants to study exporting and this arm's length exporting, I'm going to tell you why Spain is like the best place to look in the world. Because
Beside the climate.
other than the climate and other than the wine and the sherry. Oh, what I should say is when I say it's a representative sample, so these are all manufacturing firms. The sample includes every firm of more than 200 employees and 4% of all firms between 10 employees and 200 employees. So I get this very big perspective of the Spanish economy. 46% of the firms, almost half of them are exporters. And then going to your point, Ian, only 7 of that 2,200 have overseas operations. So there's no direct investment here. It's all exporting is the way they participate internationally. And for my story, it's really nice. It's a very nice experimental design that way.
Can you break down the kind of exports are? Are they manufacturing or in the?
It's all manufacturing.
All manufacturing.
All manufacturing.
Not olive oil.
Food, this type of food, I think,
processing.
olive oil would end
Yeah.
up in
Yeah,
here.
that's-
Olives, I don't think, do.
That's
It's these classifications. So yeah, that would probably be here. Another thing that's really important for my arguments and is really nice about Spain is Spain goes through an entire business cycle over my sample. So it starts out with really high growth. This is quarterly GDP growth. Really high growth at the beginning of the 1990s. In 1993, it slips into recession. And so we get 5 quarters of negative GDP growth. So I think that makes anybody's definition of what a recession is. Things spike up. Things improve in 1994. The recovery slips back down in 1996. And then things sort of go off on their merry way in growth.
I'm sorry, I didn't catch this. You have exports per destinations, right?
No, I have exports at 2 points in time in the sample. I have a general indication of where exports are going. I know if they're going to Europe or pretty much the rest of the world.
So you have a firm in Spain in 1992,
Yep.
and you know that it exports half of its goods to the EU and the other half to the rest of the world, something like that?
So what I would know is, so every year in this sample, I know a lot of characteristics about firms. I know how much they sell, I know their capital investments, those
How
types
much
of.
they sell in total?
In total. Every year I know how much they export.
In
also.
total.
In total. At 2 points in time, they're asked to break down the distribution. So no, every year I don't know where they go. But
So how are you gonna test the business cycle correlation?
right, and so here's one of the things, and Bob, this goes to your point. Europe goes through a similar, Europe has, the early 1990s were not good around the world. The correlation between the rest of Europe and Spain is about 0.8. It's not perfect. A non-European nation where Spain actually has some exports to is right next door across the Mediterranean, Morocco. The correlation between Morocco's GDP growth and Spain's is minus 0.05. So what I'm relying on is as long as we don't have perfect correlations, we get a diversification benefit.
No, but you don't know how much out of that firm's exports go to Morocco.
That's right. But all I know is that if I take a look at a firm that only that only sells in Spain, this is the environment it faces. If it doesn't just sell to Spain, it has a diversification effect. again, that diversification effect will be of different magnitudes depending on where it sells. That I won't be able to differentiate. At the same time, it should be different than the solely Spanish firm.
But you're relying, I mean, it's implicit, you're relying on some randomization across this. I mean, I guess it's possible all these guys could be shipping things nothing but to Portugal, in which case there's my guess is the correlation is 0.995, and there's something there, because it's so big, but you know, implicit in this is.
There's going to be some of that, right.
You just
You
know
can
that.
step across this border to Portugal, you can step across the border to France, those types of things. At the same time, especially even though we had the European exchange rate mechanism here, we don't have a common currency, we don't have common domestic policies, and sometimes making that one step across the border, it can be a big deal because of other policy and exchange rate implications.
But I guess my thought is that, the questions that we're presenting this it would be fair to say, look, if I got 3,000 that are representative of the country, here's what the country was shipping between 1990 and 1998. There's no reason to believe these guys are wildly different from that, and Spain's got a...
That would be the case. And what's the number one export destination for Spanish firms? It's the rest of Europe. That's true.
Excuse me, I have a question. Maybe it's very simple. So I'm confused about you just expressed some exporting firms could not affected by the domestic business cycle. You just notice this, but in my opinion, like China, like 2008, about the financial crisis. A lot of China's exporting firms, they are all affected not by our business cycle, but by the international business cycle.
Right.
They are all, most of them are bankrupt.
Right.
So I don't know if this research is more useful to explain every country's.
And I think that this sort of harkens back to the other, to the previous point also, is that really the question there is, if I rely on export markets and I can't sell my goods domestically, that's not that diversification benefit. If my export markets dry up and my domestic market's booming and I can use these goods in the domestic market because it's growing, then that's when I'm going to get the diversification. That's absolutely true. That has to be, we'd call that a boundary or some condition with respect to what I'm looking at. And again, I'm going to turn to the data in just a second, and if we see that, look, it's the exporters that have these, when good times are good, they're really good, and when bad times are bad, they're really bad, we're not going to see this stability.
But Myles, in support of what you just said, in China's case, is exactly happening to this computer company, which is now picking up the domestic market.
Right.
This business is a cycle. It's
right.
Exactly.
It would be that if that can happen,
Yeah.
that would be this type of diversification. Let me, before I actually start showing the data itself, so I want to talk a little bit, and I can move through this quickly if it bores you, how I'm going to go about, so I'm going to look at this overall stability of sales, I'm going to look at the stability of investment. How do I measure this investment liquidity constraint? How do I measure that I rely on internal funds? And I'm going to use an approach that's been common in the corporate finance literature. It's not without its problems, and I can be very honest to what those are. But here's what it is I'm going to look for a positive correlation between investment and cash flow. And let me give you some intuition behind this. So let's think about the late 1990s. And let's pretend that we're a .com firm. We could make whatever investment we wanted. It didn't matter if we were generating any cash or not. We were not investment liquidity constrained, right? If we thought we had a decent idea, we could get somebody to fund it. Let's move to today. And this is a lot of what the talk is. I can't go out and get a line of credit if I'm a business, or I can't access capital. If I'm going to make any investment, where those funds have to come from? Internally, I have to generate them. So When I have them, I can make investments. When I don't, I can't. So that's the idea or the intuition behind this test. If I'm constrained by my internal liquidity, by my internal cash, the investments I make should have this positive correlation with my cash flows. If I'm not constrained by internal liquidity, hey, whenever I have a good idea, I should be able to go out and get capital. There would be no relationship between those. Okay, here's some of the, now let's talk about some of the warts. It's a nice idea, but what are some of the problems? Cash flow can capture about 1 million other things than this investment liquidity constraint. Ones that I'm really concerned about are things like investment opportunity. I'm selling lots of goods, I have lots of cash flow because I have really great products, and I'm going to make lots of investments because I am making lots of great products and I have to increase my capital. That would lead to a positive correlation also. So the literature has done 2 things to deal with this. And I'm going to tell you what they are, and actually I think I'm going to skip getting into the equations, and I'd love to do that if you beg me to, but I'll make you beg me to do it.
I know you'd like to.
Okay, so there's 2 things that get done. Let's focus on the top one, which has no Greek letters in it. The first is what they do in this literature is, well, let's split these samples by firms that we think have different liquidity constraints before we would even move to it. And if we find this difference, it would really be supporting evidence. So they've supported it by firms making dividend payouts, whether or not firms are parts of Japanese keiretsu, and size. So the argument being, if I'm part of a Japanese keiretsu, I have sister firms, and if things are going really bad for me, I can always get capital from the parent firm. So I wouldn't expect these positive, I would expect those firms to be less liquidity constrained. Larger firms tend to have better access to capital. The other has been to control for investment opportunity. And largely what it is adding a control for Tobins Q. Look, I'm not going to walk through this. What I'm going to say is this would be cash flow, and I'm looking for a positive correlation between cash flow and investment with a bunch of controls. That's the idea there. I'm going to follow this approach, please.
Okay, can you go back to your controls?
Sure.
Again, so here's what I'm thinking. You're telling me the story and I'm trying to write the model in my mind.
Yep.
And I'm thinking, one model can be, I'm exporting to 10 destinations, I'm pulling their cash flows, summing them over, trying to borrow in order to cover the fixed cost, and then all of those cash flows are going to go to cover that fixed cost, the rest will be borrowed.
Okay. Yep.
I will get the exact same result if I just assume that firms for heterogeneous productivities, the more productive firm is simply more productive.
Right.
Can
Yep.
export more and invest
And it
more.
can invest more. Yeah. How are we going to differentiate
Yeah,
those?
I don't see
Absolutely.
that.
Absolutely. You can't get it to it just with that equation.
Are you going to be able to?
And so this is where I'm going to take, so let me tell you about, once we get to the empirical strategy of what I can do. You're right, if I just sort of look at this, and this will be the problem, is that if I document, let's just skip to it. These are things that I'm going to do. So let me get to what I'm going to do. This is the basic formulation for this type of approach. What am I going to do? I'm not going to measure Tobins Q as the growth opportunity. I'm going to look at, have you been growing in the past? And there's reasons, because I have lots of really tiny privately held firms, I can't measure things like Tobins Q. I'm going to scale by sales instead of capital investment.
Could you just say, it's simple enough, can you just explain what Tobins Q is?
Oh, Tobins Q Tobins Q was this measure of investment opportunity with the idea that that's market value of the firm over the replacement cost of capital. And if it would be very high, we would have more opportunity. There's a lot of assumptions why that would be a measure for growth, because I'd have to assume why marginal Q and average Q are the same, and we need some heroic assumptions to do that.
But that's the basic.
But that's something along the lines of what I'm going to estimate. Again, not dealing with this right now of how I'm going to tease this out. I'll use firm fixed effects and cluster by standard errors. So let's talk about the sample a little bit more. And again, we can go back to the details if we want. I'm going to restrict this to firms that appeared for all 9 years in my panel to equate the survival bias. And here's what I mean by that, is that one of the arguments of this investment liquidity constraint, this cash flow correlation, is it doesn't work for that it could be extremely misleading for financially distressed firms. And to do that is I want to sort of take out the financially distressed firms, get some sort of ex post version that these are all viable firms over the sample because they survived. In some ways, if the firms that don't export are smaller and more susceptible to this, I'm probably introducing a conservative bias in my results. I'm also going to restrict this to firms that provide data about capital investment over the entire 9 years. And since capital investment is really what I want to trace as happening to them, what I want to do is make sure that there aren't missing years because there might be a big spike or a drop or things like that. So all the firms report capital investment. What I will say, and it's interesting in the fact that I can draw from such small firms, there's a number of firms that report zero capital investment in a given year. It's not that it's missing, they just didn't do any. They're small enough that it wouldn't make sense.
Do your results go away if you start adding firms that didn't survive?
I have not looked at that, actually. I wanted to pull them out just because there was a lot of noise, even before getting into this. Here are 3 things that I'm going to do, again, going back to that, and it will sort of help tease out the empirical methodology. I'm going to separate that group of firms into 3 subsamples. First of all, Spain, like almost every other country other than the United States and the UK, we have business groups. Some of them are family-centered. So one of the questions on this survey is, are you integrated into a larger business group? So any firm that's a Spanish firm that's part of a Spanish business group, and this also picks up subsidiaries of foreign multinationals in Spain. These firms have much more direct ways to access capital internally rather than exporting. So I don't expect this exporting story to hold for them. I want to hold them separately. I'm going to call these affiliated firms. Now I want to look at all the firms that say that they're not part of a larger business group. And you can see here's going to be my empirical strategy. I'm going to look at the firms that didn't export over the entire panel. I'm going to compare them to those that exported over the entire panel. And you know, there's another third of firms that switched exporting status over that panel. And so, as was alluded to, there could be hundreds of differences between these exporters and non-exporters that lead to this difference. If we find a difference here, I want to take these switchers and see, do they look like non-exporters when they weren't exporting, and do they look like exporters where they were? Can I show that something happens when they switch exporting status? That's going to be my empirical strategy. Okay, here are the numbers, and this will at first at least empirically address this question. Do they have more stable sales and capital investment? So let's focus first on capital investments. These are the non-exporters, these are the exporters. These are the mean of the within-firm means. These are the mean of the within-firm standard deviations. So in other words, the average amount of capital investment, and it's scaled by sales, expressed as a percentage. So if I take a look at the average level of capital investment, let's start with cash flow. Take the average level of cash flow divided by sales for the non-exporters and the exporters. Those 2 numbers don't test different from each other. So on average over this 9 years, they had the same cash flow percentages as a percentage of sales. These are the standard deviations. They test different from each other. So the exporters had even though the average level of cash flow was the same, there was less variability for the exporters. And the same thing is true when it comes to capital investment. Even though the average level of capital investment over those 9 years was the same, it was much more variable, because these test different, these don't. It was much more variable for the non-exporters. So again, the points are very true, is that if exporters could only sell to that market and that market dried up, they couldn't do anything. I might see like more of this magnification rather than this, but with these Spanish firms, I can see that sort of first expectation. They have more stable cash flows, and they have more stable capital investments.
Myles, these are statistically significant differences. Give us a sense of their practical.
And so again, we were
relevance.
talking about a standard deviation that's a third, 33%
Yeah.
bigger. And again, if you sort of want to calculate sort of a z-score, that these are actually practically important. So,
How big are the companies on average? Sales-wise?
well, it depends. I can tell you by type.
That's where I'm trying to get a sense of.
Yeah. So here's the thing: is unless you do I have the right description? Yeah, these are the better descriptive statistics. Okay, so the average affiliated firm is like 1.7 million pesetas. No, that means nothing to you. So let me give you sizes and something that's useful. So the number of employees. The typical, the firm that doesn't export over the entire panel, its average size is about 27 employees. Those are tiny. Those that export over the entire panel, its average size is about 160 employees. The affiliated firms, which are the foreign multinationals and the business group firms, those are about 700 employees. So there's absolutely a size difference. If you look at the descriptive statistics, what's also really nice about the switchers is they end up right in the middle. That's what looks like they were somewhere in between. So that gives you a sense of some of the size. So like I say, first point that I want to make, yeah, those exporters have more stable sales, they have more stable capital investments, but that average level over those 9 years weren't different.
Yeah. I'm just going back to your introduction. You very well defined an efficient firm. And the exporting firm, in terms of productivity, tend to be more efficient.
Yep.
Then the characteristic of this firm are different from the
Yep.
other firm. So therefore, their access to whether efficient or inefficient capital market, you see, will be better than the other firms.
Right.
And one other point is, for example, you did mention Japan, but it's also true in China cases. The capital market is a little different, that they have a relationship with the banks and the government, as well as the companies and SOEs, but it is also the banks, on that effect.
Right.
So what I'm saying that I think the implication, as I see it, more productive, that irrespective of the system you are working, that the exporting firm as efficient is likely to have more access
Yep.
to the capital, and some of it may be that their internal, their saving may be larger in that, but if not, depending on the capital markets, one doesn't have to say it's not efficient, but even in the inefficient market, there may be a degree of.
So two things. One, and I think this is one of the points you're getting to, is if I show a difference between exporters and non-exporters, it could be the fact that they're exporters or all these other things that correlate between exporters and non-exporters that drive the results. Absolutely. And I'm going to do my best to show that it's exporting. So that's sort of the goal. That's the task that I have to live up to if I want to make the conclusion I want to make. The second point that you're saying is, you're right. One of the things that I can say, again, going back to the Spanish setting, is capital markets are not as developed in Spain as they are in the United States, for instance. And so do we have I don't think we have perfectly efficient capital markets in the United States. I certainly don't think we have perfectly efficient capital markets in Spain either. As long as they're not perfectly efficient, it raises this potential that we have to rely on internal funds. Now, I think, Mahmoud, as you mentioned, and I think it's very consistent with the arguments, as a firm, is there something I can do to signal or give information that I am worthy of this investment. And if I can do that, I can access external capital. Otherwise, I can't. And so that's where I'm going to go right now. The first thing I've just shown is I wanted to show that they were more stable, both in terms of cash flow and in terms of capital investment. So let me explain what this is, and I'll tell you the approach. Remember I said what I want to look at in this test is what's this correlation between cash flow and investment. And I want to look at this correlation between different types of firms. My arguments were the non-exporters, if their investment liquidity constrained, their cash flow should be positively correlated with investment. If the unaffiliated exporters are less so, or they're not liquidity constrained, this shouldn't be different from zero. And these affiliated firms, those are the ones that have sister companies. Well, I don't expect them to be liquidity constrained. I don't really know what they're going to be beyond that. And so these are the interaction terms. Those were the controls for growth, controlling for debt. For those of you who care about the specification, this is the damn if you do, damned if you don't variable. The typical approach in this literature doesn't control for debt. I don't control for it. Somebody jumps up and down and says you haven't controlled for debt. I control for it. Somebody jumps up and down and says that's not consistent with the approach in this literature. So it doesn't matter if it's in there or not, by the way. So, but it's in there now. So since these are the interactions, these are going to be the deviations from the excluded case. So if this is the excluded case, I'm expecting this to be positive and significant, this to be
Negative
relative to that, and this, who knows? What do I find? And then I'm going to show you what I find, and then I'm going to move to a different set of results to interpret the magnitudes. This is positive and significant, as I expected. This is negative, and actually when you add those two together, it becomes just negative, but it doesn't test different from zero. It's zero. This is really negative. When you add these two together, you get a significant negative effect. This literature on investment cash flow sensitivity, it does find negative cash flow investment sensitivity within Japanese keiretsu. And what's the idea there? We're making lots of money, we get it siphoned off to our sister companies. Things are going really bad, we get all sorts of cash inflowing to turn things around. I'm finding that within these business group firms. That's not a really big number. How do we interpret it? The interpretation I like for this, especially these firms that don't export, since they are small, they have lots of zeros for capital investment. And so one can imagine that, look, if things got really bad, not only would we not invest anymore, we might start retiring or selling off capital. So this is really a limited or truncated dependent variable. So to interpret it, I want to move to a Tobit estimate. And I'm going to move to a panel Tobit.
So before we do this, just Myles, what's the estimator here?
GLS, fixed effects, standard errors clustered by firms. Firm fixed effects, standard errors clustered by firms.
Just for fun, if we were to do this all less, we shouldn't, but how much of the variation would we explain with this?
You're asking me to remember this, and I haven't done it for a long time. So
This is if you just
the within, so
Right, yeah, just kind of, the R squared. Just kind
so
of
the within firm R squared.
Yeah, right.
So pulling out the fixed effects, I'm around 5%. Which,
But there's like an overall too, don't they give you like
yeah, the overall is going to be much higher with the fixed effects, and I just report the within firm.
okay. So a few things, so just you got
Yep.
here, what's not there? So I know you have manufacturing firms, but there's obviously diversity across that.
Yep.
Do we know about industry, and does it make any sense to include industry dummies?
Industry dummies move in, and it
Doesn't
doesn't affect it. Yeah.
Okay, are there a couple of, and you got time dummies, right?
Yep.
So we have year that goes with it. Do we have any other kind of, within time, or do we have any kind of multi-year effects that we should be concerned about that we can explicitly
Yep.
control for, say, crises?
Yep.
And the like?
Yeah, so this is what I've done with respect to a number of those things. So time effects are in. If I change time effects and look for time trends, nothing changes. If I collapse the panel if there's some sort of momentum, so if I collapse the panel to expanding GDP and contracting GDP, I get the same thing. I've looked at a number of
That's
those.
what I'm just trying to think about this. Do you know just a couple of things offhand? From it's a questionnaire data on this, and
Yep.
I don't know, volunteer all sorts of
Yeah.
RA time to correlate, but do we know anything about, like you say, you anticipate my question about capital structure of the firms and debt.
Yep.
So you do, but you're damned if you do or don't. Do we know we know something about ownership insofar as we know about
Business
whether you're part of a
group.
group or not?
Yeah.
Do we know anything more about the nature of ownership? So for instance, the number of owners, whether they're foreign owners and the like.
Yeah.
This could be another source of
Yep.
capital, right?
Yep.
This is about raising capital, so if I've
Yep.
got, do we know anything about listings, whether they're listed on a public exchange or not, and whether
Yep.
there are any foreign listings?
Yep. So here's what we know with respect to all of those. All the subsidiaries of foreign-owned firms end up in that affiliated group.
Okay.
So they're lumped together. The vast majority of these are not publicly traded.
Right, they're all small, that's why the fact
No,
that
that's
small,
like
20
90-some%. I haven't separated the few publicly traded ones from this.
And then you know something about the manufacturing facilities. Do you know anything about identifiable assets overseas? And so what
Yeah,
I'm thinking about is some
only
of these
7 of
areas,
them have
identifiable
assets overseas, and if I move in those 7, it doesn't matter. Let me comment on that too, because often when I say there are only 7 Spanish firms that have direct investments, everybody goes, that just can't be right. And this is generally the question I pose is, what are the Spanish multinationals that come to mind when you think of them? And actually, there are Telefonica,
Yeah.
Banco Santander. The Spanish multinationals that come to mind are like heavily in banking and services. They tend not to be manufacturing firms, so there's actually a face validity to
Right,
this.
the defense, I'm sure there's some leftover old phalanges businesses and that too. That's another story. But so the last thing about this is actually back to the owners, because I just think this is small companies. This is you're kind
Yep.
of giving this. This is like this. This is kind of a story about Jeffersonian small businesses, right? I mean, it's kind of this little
Yep.
shopkeeper businesses, but the ownership I think kind of matters. There's this woman Mara Faccio, who's a finance scholar, who's got a great paper in the Journal of Financial Economics about who really owns European firms, and
Right.
she has a study and it focuses on these Spanish firms. We
Yep.
talked about this. Now these are little firms, but there's this story about how
and-
figuring out ownership of a Spanish firm is like figuring out who owns Vegas casinos during the mob days.
Yeah,
right?
there's a little bit about that, and here's where I'm relying on, and you can see within the percentage of it, here's where I'm relying on the survey data. It's like, are you affiliated with another company? And again, there, rather than sort of tracing publicly available records or that, I think that's actually better, but it's certainly not prone to being perfect, shall we say.
We don't want to let the perfect be the enemy of the good. This is very good.
So again, there's some, I will say this. The sort of split of how it falls out between panel exporters, non-exporters, and that was just, that happened. I didn't know that in the data. It just ended up being great. So,
Yeah.
Let me throw out one other one.
Yeah.
Since we're talking about these little, where they are might matter too. Might be an interesting one. Where in Spain? So
Yep.
literally, are you in Madrid or Barcelona?
Yep.
Or essentially, or Barcelona? Are you
Yep.
the rest of this, right? Because if you're in Hooterville, or what is it? We're the Astoria. I guess that's what it is. That's the Prince of Astoria. I mean, that's a different. I think that's because when we're getting these small firms, actually,
Yeah.
it might matter.
it might matter. Yeah. I think I can tease them out. Here's the good thing about the data and the bad thing about the data. The data are extremely comprehensive, and I can identify the firms consistently within the data over time, but the firm identities are not known to me. So I have an identifier, but I have no idea what firm that is. And so I might have like some region,
That's
and I'm not sure.
Or even just city, just a.
See, that I don't have their address, for instance.
Oh.
I don't know where they are, that specifically.
Do they show products? I mean,
They show
talk
general
about
industries.
Oil, we're leaving the site, but.
Yeah, no, there is industry, and they would be, the industry classifications, I would say, would be around the equivalent of 2 or 3 digit SICs in the United States.
So it's-
They're somewhat aggregated. I want to make sense of these results. And these are the Tobins. And again, you can see the magnitude's bigger. Here's what's important in my mind. The elasticity of this is 1 for the non-exporters. So in other words, when this variable increases by 1%, the investment by sales increases 1%. That's meaningful in my mind. This effect is 0 for the exporters. So going back to your, I think there's actually an economic significance here, even though those numbers might not be really large. Now let me go exactly to the question that was being asked. It's like, yeah, are they really sort of switching their sales? Why are they getting this stability? So here I'm going to focus on the firms that were the panel exporters. And the pink series here is their domestic sales. And you can see their domestic sales track that graph of the domestic economy. Things are going really great at the beginning of the decade. 93, 94 are in the dumps. Things recover, they slip back, and then off we go. That's what their domestic sales look like. Now I'm going to impose their export sales on here. And just to be clear, look, this is the scale for domestic. This is the scale for exporters. They're not the same, so don't say that I told you they were. Look at this series. Nothing's happening. The domestic economy goes into the toilet. What happens? It starts to pick up, and it shoots up at its lowest point. The domestic economy recovers, exports drop down. Domestic economy relapses, exports shoot up, economy is on a boom, and this starts to level off.
Okay, so here's an alternative.
Yep.
Which is you've got the fittest, you've got the great flexible players here, right? Because you didn't include the non-survivors on this. They dropped out. So I could show you a lot of really similar data about that for a bunch of different countries, and that would just be a sign of productive firms. These are the good firms that are responding to it.
Right. Here's what I would say, but all the responses in exports, because if I plot the series for the domestic-only firms, it looks a lot like this. So all the flexibility is coming through export sales. Again, which would be consistent with mine. You're right. And again, look, these scales are different, so we still have this effect that it dips down when the domestic economy goes into the toilet, but it's actually less pronounced. And again, if I correlate these two series, they correlate at like -4.5. So it looks like when domestic sales are going up, exports are dropping and vice versa. So I have, at least within these exporters, some evidence it looks like there is this switching going on. And again, might that be something unique to the Spanish firms? It could be. I don't want to make the claim otherwise.
These are the same firms, right?
Yep.
And I imagine like 90% of their exports are OECD or something. Or
Yeah, it's a very high proportion.
What
Yep.
is the business cycle correlation for that 10-year period between Spain and the...
Spain and the EU, it's like 0.8 something.
So during that period,
Yep.
it's positive.
Yeah, no, it's not perfect, but it's positive. Yep.
Have you plotted this against the exchange rate?
Okay, and this is one of the interesting things that happens is, at the worst of it, even though they're in the European exchange rate mechanism, they devalue the peseta, which makes all their exports more valuable in terms of peseta.
Excuse me.
Yeah. Which has the effect of stabilizing their peseta sales.
Also protects their domestic market.
And it did protect their domestic market somewhat, absolutely. So that's that did happen.
So that's
But we're seeing-
a major policy intervention.
And that was a policy intervention that could have had this effect. Like I said, absolutely, that's important. And we still see some adjustment after the fact, though, when they don't reset things. But that
When
could,
was the devaluation? 94?
right around the trough, right around here. Absolutely. And again, that's another way in which this can affect it. It's not just unit sales, but it's domestic currency denominated sales.
And any trade liberalization within this period?
No, so that's really interesting. Is right that a lot of the EU liberalization was all at the beginning of the period. And so what I can't show you.
You are in the Uruguay round implementation period in '94.
Isn't this a single market thing, whatever you were doing in the 90s?
Yeah, it was up here.
92.
It was before the 1990s?
No, so it was like 91, 92, we started to have the single market. What's really interesting, this is complete aside. What's really interesting is if you look at those investments, how are we doing for time, by the way?
10 minutes.
What's really interesting, if you look at the investments by those affiliated firms, the foreign multinationals are building tons of plants in Spain in 1990. It's like sort of by 2 or 3 times more than what they do over the rest of the entire period. They were gearing up for the European market. Absolutely clear. So again, I have some of this notion of switching. Here's where I want to take advantage of the switchers. And my approach is going to be a differences and differences estimator. So what I'm going to do, this is going to measure the effect of those firms that are not exporters. And I'm expecting that positive, significant effect. When I interact a switcher firm with that, this is going to be how much the switchers differ from the non-exporters when they don't export. This is going to be how much the exporters differ from the non-exporters. This is going to be how much the switchers differ from the exporters when the switchers are exporting. Let me take a step back. Just like in the other one for the non-exporters, I expect that correlation to be positive and significant. I expect when I add these two that they're going to be 0, so I expect this to be negative significant. And if those switchers look like the exporters when they export and the non-exporters when they don't export, these should be 0. And that's what I find. And again, the magnitude of these effects are really tiny. Something happens on the switch. And I can start to play with these switchers that some of the firms switch multiple times. I can get rid of the multiple switchers. I can put the single switchers in. I can look at them switching from exporting to non-exporting, non-exporting to exporting, although some of those samples become really small. And you get this. Something happens on the switch in both directions in that cash flow investment sensitivity. Final thing. One more sort of calibration. Are the exporters, again, they are bigger, but are they really more liquidity constrained than the non-exporters? This is based on a paper by Cabral and Mata. Argue that if we take a look at the log size of firms that are not liquidity constrained, the log of their size should get us pretty much a normal shape curve. If firms are liquidity constrained, we should have a curve that's very skewed to the left, because firms can't get capital to actually grow. That's what we find here too. So for the non-exporters, they're fitting this size distribution of liquidity constrained firms, and for exporters, they're not. Again, this one it just could be size or things like that. But going back to some of these alternative explanations, it's things like size. Size doesn't change immediately on the commencing of exporting. The firms tend to grow, but there's something on that switch.
So Myles, I was thinking of a couple other things you probably didn't, but I was thinking one about if we're dealing with correlation and causation,
Yep.
think of simple Granger causal models. So we're addressing this year and last year, and then it's the last year, whatever it is, the last year and of an exporter. And then and you could thinking of doing that across the different groups on a time series basis, but I was thinking more for a panel. I was thinking about some of these dynamic panel analyses where the RNO bond stuff, where you might, again, include a lag dependent variable on the right hand side to capture all the other things, and then just let them figure out the instruments for you. And wouldn't that be? I mean, does that strike you as a helpful strategy for at least robustness, or is that not?
Yeah, so it's true I'm relying a lot on the switchers, and that's a big deal, and the variation within the switchers. Are there alternative ways to go? You know, absolutely, one could think of those types of things. I'm not so sure that we're going to get, there are a number of things I'm trying to use to control for some of these unobserved effects. I don't know if really moving into dynamic panel is going to help me much.
Just a lag dependent variable, right?
Here's what I'll say about the lag-dependent variable, and here's something a little bit in the sensitivity. My arguments are there's something about being an exporter. So going from no exporting to exporting is going to be much more important than, say, I have 10% of my sales as exports and I move to 15%. So if I take out this dichotomous variable that I export and I see how much you export, almost everything goes away. It's this entry or exit into the exporting status that seems to be driving things. Next, yeah.
No, that's fine.
You, at the beginning, you'd said exporting was an outcome.
Yep.
You wanted to see if it was also,
Yeah.
so where's the evidence that these firms are more innovative?
Oh, sorry. The innovative is a different paper. What this one is saying is that once they become exporters, that they seem to not be constrained by their internal cash flows anymore. They have better access to capital, and they aren't as restricted to the domestic market. So that's how exporting is more than an outcome that I want to focus on here. And I can share you the innovative paper some other time. Molly.
I just wanted to get back to the conceptual part, which I like, among the two the domestic firms or the non-exporting firms. If we look at the literature theory of the firm, one generally would say often the firms practice at home. They become efficient in the domestic market.
Yep.
And then they begin to expand.
Yep.
I know my career followed 3M, that how the 3M's exports had continued to increase over time. So is it possible that there are firms in that sample which have both components?
Productivity and export. So here's what I'll say, and this we know from the Spanish data. The exporters are absolutely more productive than the non-exporters, but that switch to exporting, they're already more productive before they switched. So if we want the productivity argument, that their TFPs were much higher years prior to exporting. So it's not like productivity switched on the exporting switch. The productivity switch preceded the exporting switch, and we see this differential effect in investment liquidity constraint actually on the exporting switch.
And I think that's an important point.
That's a good point. Yeah, thanks.
Total factor productivity.
Yep.
Yeah, I just want
Sorry.
to make sure.
Yeah, sorry.
The total factor.
Here's what I'll say about the approach. Right? Any one analysis here is subject to lots of alternative explanations. And there could be lots of things going on. The strategy really is, let's look at multiple things, and can I paint a picture that we look at this and we keep on slicing it in different ways, we get results that are consistent with what I'm trying to argue. And I'm trying to make that point. That's my strategy. We'll skip that. And this is the final point. So when it comes to these policy considerations, and again, this would be one of the things I argued for two potential mechanisms that were both information revealing that could lead to this effect. And identifying them would be really important for policy. I haven't figured out how to identify them yet or try and separate them. If anybody has any thoughts, I'd be delighted to know, of course. I think that, there's a point that was highlighted earlier on, but that might be a nice way to try and tease some of that out.
Well, that was truly remarkable.
Thank you.
Folks, we have one